Banks touch our lives every single day. We rely on them for safekeeping our savings, for receiving salaries, investing our money, taking loans, and making digital payments. Across the country, banks handle millions, sometimes billions, of rupees daily. But if banks pay out interest, operate thousands of branches, support armies of employees, and invest in new technology, how do they turn a profit? Where does all that money come from? Today, let's uncover the fundamental secrets of banking profits in the simplest way possible. MintMind is your guide to banking, insurance, and finance, made easy for everyone. Let's get started. Imagine you deposit 1 Indian rupee lakh in your savings account. The bank isn't just safeguarding that money, it's putting it to work. Banks collect deposits from countless customers. Then they lend out a major share of those funds as loans, be it home loans, car loans, personal loans, or business loans. Here's the crux. They pay depositors a lower interest rate, perhaps 3%, but charge borrowers much higher, say 10% on loans. The gap between what banks earn from loans and what they pay on deposits is called net interest income. This is the core engine that powers most banks. Zooming in on these numbers makes it even clearer. If thousands are earning 3% on savings and thousands are paying 10% on loans, banks pocket the difference. This interest spread forms a huge chunk of their income. But with lending comes risks. Banks scrutinize credit scores, income, and repayment ability before approving loans. Safe lending is essential. Defaulted loans can hurt a bank's bottom line. Loans aren't the only way banks earn. There are fees, ATM usage, credit card maintenance, loan processing, late payment penalties, and even small charges for SMS alerts or foreign transactions. Each charge may be minor, but when multiplied by millions, they add up fast. Digital banking has created even more opportunities. Banks make money on online transaction processing, merchant payments, and value-added digital services. Banks also invest, but carefully. Regulations restrict risky bets with customer deposits. Most banks buy government securities, bonds, or treasury instruments. These investments offer safe returns and support steady profit, managed by dedicated investment divisions and treasury teams. Yet, banking carries real risks. If borrowers stop paying, banks lose money. These unpaid loans, called non-performing assets or NPAs, can threaten a bank's entire stability. To guard against this, banks conduct thorough credit analysis, manage risks, and actively pursue loan recovery. Responsible lending protects both customers and the health of the entire financial system. Technology has revolutionized modern banking. With mobile apps, UPI, online banking, and digital wallets, banks serve more customers, lower operational costs, and boost efficiency. Digital banking now generates its own revenues and improves customer convenience. Looking ahead, AI and automation will likely transform banking even further. Banks aren't just profit makers, they fuel economic growth. They support business expansion, help families buy homes, fund education dreams, and empower entrepreneurs. The money that banks move keeps economies growing. They truly are the backbone of development, investment, and job creation. To recap, banks make money by collecting deposits, offering loans, and earning the interest spread. They also generate revenue through fees, investments, and digital services. At the same time, they must manage risks and loan defaults wisely. And banks play a pivotal role in supporting economic progress. If this breakdown made banking simpler for you, subscribe to MintMind for clear, daily explanations on banking, insurance, and finance. Let us know, what banking topic should we clarify next? Thanks for joining us today, and we look forward to our next lesson together.